Just how bad is it really going to be, and how can we perhaps ease some of the downside pain?
Well, in our baseline projections, what we are seeing is the global economy slowing down from about 3.2% growth in 2022 to about 2.7% next year in 2023. So that's, the 2.7 is a downward revision from what we were expecting earlier. We're expecting 2.9, we're now expecting 2.7, so it's coming down. It's still positive, but when you look under the hood, what we found out is that about a third of the global economy is going to be experiencing a contraction, 2 consecutive quarters of negative growth. So there's going to be a lot of slowdown, a lot of economic pain going down in terms of what we'll see next year, and inflation will still be somewhat elevated. And so what we're seeing is, this battle to bring down inflation is underway. It's going to slow down growth. Inflation is gradually going to come down, but next year is going to feel painful.
The fund talked about the need to avoid policy mistakes. The Fed has lifted interest rates more aggressively and at a quicker pace than I think we've seen in any previous cycle in recent memory. We're starting to see volatility and disruption in some segments of the financial markets. How worried are you that we are already now very close to a policy error, or indeed something breaking in the credit markets?
Well, we have to think about central banks as having multiple objectives. So price stability is one, and that's certainly what they are trying to do. If you think about the Federal Reserve, increase the policy rates, tighten monetary policy to try to address these price pressures. They also have to look at the financial system and the stability of the financial system. And if there are some pockets of instability that emerge, then they can also deploy other tools to deal with that. So standing facilities, repo instruments, to try to address these sort of pockets of illiquidity. This is what we've seen the Bank of England doing in the last 2 weeks. Some pressures emerged in terms of the gilt market, and the Bank of England came in and said, well, we're going to come into that market, we're going to purchase, we're going to put in place a facility. So it's this difficult act that central banks are going to navigate, because on the one hand, they need to tighten policy to address inflation pressures. The financial system has lived for many, many years with this very, very low interest rate, so it's not used to the change, and it has to adapt. And, things are going to creak and things are going to be under stress. And the central banks, as financial stability guarantors, are going to have to come in and make sure that things don't break.
Was this a self-inflicted injury by the British government and the Chancellor's budget with unfunded liabilities, or are we discovering that actually a lot of the financial economy is in a precarious position because we had low interest rates for too long, and actually there are pockets of risk now in the shadow banking sector?
Well, one of the key drivers here, and that's a message that we've been conveying, is in that phase where central banks are going to be tightening, it's very important that fiscal policy doesn't go in the opposite direction. It would be like having, 2 people in a car, each of them with a steering wheel, and trying to steer the car in a different direction. Cannot work. So central banks really need to sort of bring inflation under control. It's absolutely essential. It's a bedrock for macroeconomic and financial stability going forward. And so what was announced in the case of the UK, but not just the UK sometimes, is a program that was very expansionary. So that was directly contradicting the objective of monetary policy. So market reacted to that with some nervousness. And then that nervousness generated some illiquidity in some parts of the market, the pension funds in particular. So clearly, the overall message here is let's make sure that we have fiscal policies that is very important. There is an energy crisis. There is a need to provide relief and support to households, vulnerable households. Let's try to do this in a way that is consistent with what central banks are trying to accomplish.
Has the UK just become a poster child for economic illiteracy as far as the fund is concerned?
No, certainly not. But I think that what we've seen is, we've welcomed the recent developments, the fact that the government has announced a fiscal event at the end of the month, that OBR is going to be involved in evaluating the proposals. So I think all of this is going in the direction of, let's do a 360 on the fiscal plans, and let's make sure that we're all pulling in the same direction.